Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, to discuss the difference of performance between the market cap versus equal weighted Nasdaq-100, one of my favorite topics to cover. Mark, it's great to see you as always. Welcome back to Trade Talks. And before we get into the difference there, let's just reflect and look at the performance between the Nasdaq-100 and S&P 500.
Thanks so much, Jill. Great to be with you as always. And yeah, I mean, if this holds up for how January is turning out through the end of the month, we're going to see a pretty nice start to the year. Of course, last tough year of performance for the regular old market cap weighted Nasdaq 100 index, the NDX, down just over 32% on a total return basis. That's about 14 percentage points worse than the S&P 500. You can see on this chart here of annual returns going back to 2008. That's by far the worst performance disparity we've seen. Still, though, over the long term, right, you've got 11 of the past 15 calendar years. It's outperformed the S&P 500, including by 30 percentage points in 2020. And then on the right, you can see despite that, despite that challenging year of performance, we're still doubling the cumulative returns of the S&P 500 since the beginning of 2008. So outperformance long term, still on track despite a hiccup last year. And so far this year, we're already seeing around 5-6 percentage points of outperformance versus the S&P as January has gotten off to a solid start.
Now, how about the difference that you see in the performance of the market weight cap Nasdaq 100, and then of course the equal weighted cap in the Nasdaq 100? What can you discern from there?
Yeah, so a lot of people may not know that there is an equal weighted version of the Nasdaq 100. It is tracked by a couple products here in the U.S. From the likes of First Trust and Direction, little under 2 billion of AUM attached to those ETFs tracking the equal weighted index. I decided to go back, as far back as we can with the history of the equal weight, just to put the performance differential in perspective last year, where you saw the equal weight outperform by about 8 percentage points. That was one of the best performances we've seen historically, the best one since 2003. So you're talking about, a 20-year kind of a record in terms of the outperformance potential of the equal weight versus the Nasdaq 100, and that has a lot to do with things that are kind of happening under the hood of both indexes, right? In terms of what the biggest names in the NDX are doing, sort of what's the overall investment trend between value versus growth, between large cap versus kind of smaller and mid cap. So a lot of kind of interesting divergences that happened last year to cause the equal weighted version to outperform. And we just want to remind investors that, there are a lot of products. I think there's over 30 ETFs tracking the Nasdaq 100, all with different strategies these days. The equal weighted version is just one of the sort of more liquid, bigger success stories out there outside of the regular old Nasdaq 100. If you're looking for a different way to access that index today.
All right. And Mark, what about the impact of lower concentration?
Yeah, so I mean, this kind of illustrates what happened last year, right? If you look at on the left there in that table, these are the 7 biggest names in the Nasdaq 100, the cap weighted version, around 50% of the index weight. On average, these 7 names, Amazon, Tesla, Apple, Meta, Microsoft, NVIDIA, Alphabet, on average, the loss last year was 46%. So of that 33% loss for the index, 21%, about 2/3 came from just these 7 names, right? But then if you look at the equal weighted version, where every single name gets 1% of the weighting, that version of the index, these names contributed only 3% of the loss. So you're talking about, on average, a reduction of 83% in the return contribution. What they contributed loss-wise to the cap weighted versus the equal weighted. And then on the right-hand side, you've got a little bit of a different view, which is the sector view, right? So just within technology, You've got a massive reduction of concentration from 55% from the regular Nasdaq-100 to 35% for the equal weight. You've got offsetting increases, most notably, I would say, in healthcare and industrials, which are even utilities, kind of a nice bump there, which are, you know, increasingly today with higher rates being seen as more of a kind of value, more of a kind of a cyclical play. And it really does illustrates the diversity of companies that are in this index. It's just that a lot of times, especially over the last, call it decade and a half, the top half of the index, which is very concentrated, right, has driven a lot of the performance on the way up. We see that on the way down as well. We've seen similar things happen about 20 years ago, when a lot of the biggest names in the Nasdaq-100 came under pressure for multiple years. Think about, you know, Microsoft's troubles with antitrust and the Justice Department. In the US, you're seeing kind of similar things maybe get underway now, with Alphabet, with Meta, with Apple potentially. So things for investors, you know, to pay attention to again. And even if you're not sold on the Nasdaq-100 for this year and going forward, again, we want to remind folks that the equal weighted products, they are out there. They track this index. It's a long track record. It's a pretty straightforward way of continuing to access, you know, the really innovative streak within these companies, just with a bit less risk, we think, a bit less concentration.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.